So now the Fed is forced to inject liquidity into the repo market, i.e. the banks and the money market funds, or in lieu of the banks and money market funds, because they don't have sufficient liquidity to buy the collateral that's being offered. And that's why repo rates went up. And if they don't do that, they would have lost control of the price of money, i.e. the Fed funds rate.
Hello there, my friends. Chris Marcus here with you for Arcadia Economics. Today we are digging back into the gold and silver world as the Federal Reserve is doing repos, buying short-term treasuries, and a whole bunch of other wild stuff. So with that said, it's a pleasure to have David Brady on the line, former money manager, now is a contributor as a writer to Sprott Money. And it's nice because in addition to digging into the fundamentals, David's also quite well versed on the technical side. So David, great to have you on here today. How are you doing, my friend?
Pretty good, Chris. Thanks for having me.
Well, it's a pleasure catching up with you again. I remember last time we talked, we were wondering if Trump was just going to keep pushing it until he started getting rate cuts, which have happened. We're not to zero or negative territory yet, as he might like. But a lot of things going on with the Fed. So maybe just to start things off, could give us an overview of what you're seeing out there, and then we'll turn it to gold and silver.
Oh, well, let me start with what you just mentioned, Chris. This issue with regard to the trade war, as we've spoken about before, I believe that's just a smokescreen for what the Fed's been doing. I mean, the Fed owns this. Trump has been in office, 3 years? We can't blame the last guy to the party for the mess that's resulted. The Fed filled a swimming pool with gasoline, and he's providing the match, for want of a better term. They've been created a credit bubble of historic magnitude, and Trump's actions are slowing the economy at the same time. But the Fed owns this, and so Trump's trade war, I expect that's not going to be resolved anytime soon. But the issue that's facing the Fed, and they're trying to address, and they're trying to point the finger at Trump, and with the help of the mainstream media will probably be successful in doing so. But the issue they face right now is that they facilitated government spending to a great extent with their zero interest rate policy and their quantitative easing since 2009. But it goes back to 2000 and 1987, the responses from Greenspan to both of those events. And what we've got now is soaring deficits and debt. And that means a massive increase in new and maturing treasury bonds. But at the same time, foreign central banks have wised up to this. Certainly China has, and foreign central banks are net sellers of US treasuries since at least 2016. So this forced the Treasury to get the commercial banks and the money market funds to buy and hold US treasuries. And one of the reasons why we had this repo crisis recently is in the process of having to buy all of these treasuries and other debt that's coming to the market, the banks and money market funds run out of cash, run out of liquidity. And how do we know this? Well, excess reserves have dwindled. And this is what Powell keeps harping on about, is the excess reserves are not sufficient to maintain the stability and normalcy of the system. So now the Fed is forced to inject liquidity into the repo market, i.e. the banks and the money market funds, or in lieu of the banks and money market funds, because they don't have sufficient liquidity to buy the collateral that's being offered. And that's why repo rates went up. And if they don't do that, they would have lost control of the price of money, i.e. the Fed funds rate. And now we get to, they've done made the announcement about the injection of liquidity there last week, which I want to point out on the quick aside, that was supposed to come at the next FOMC. They did it ahead of time, which to me means it was an emergency measure. So I don't know what they saw, but they obviously saw something that we didn't that forced them to act ahead of time. So I think that's worth noting. That just shows how fragile the system is right now. And we can debate whether or not what they're doing is QE, QE light, QE4. But the fact is they're printing money out of thin air to buy US treasuries. The balance sheet is increasing also. So yeah, this is QE as far as I'm concerned, but we could debate that. Um, but the big issue is it's only at the front end of the yield curve. So this frees up liquidity for the banks to buy equities, and we know that the BOJ is buying U.S. securities, including U.S. equities too. And liquidity is all that matters to stocks at the end of the day. So with the BOJ, the ECB, and the Swiss National Bank likely also involved, and now the Fed too, printing again, all of the above printing, the risk is higher equities in the short term. But we're seeing flows out of long bonds into equities as a result. Long yields are rising. A lot of people expected yields to continue lower, the 10-year below 1%, given the rally that we've experienced. But now we're seeing the 10-year yield rising to 175 again this morning, and continue to rise in my expectation. The yield curve as a result is steepening. With the Fed's actions at the short end of the curve, they're keeping rates down, including the repo rates. And with the long yields going up, you're getting yield curve steepening. At the same time, the economic data, led by, of course, the infamous ISM data, the manufacturing and services data, has been awful. Growth is slowing, obviously, and when growth is slowing, inflation expectations tend to drop. Well, higher yields at the same time that inflation expectations are falling means higher real yields. And this gets back to the whole point with regard to one of the main reasons for having this call, Chris, is gold and silver. Higher but gold and silver have been highly correlated to real yields since November of last year. You run a correlation coefficient and you'll get somewhere close to minus 0.97 because it's an inverse correlation. So it's near perfect. Higher real yields mean lower gold and silver prices.
Right.
And that's what we're seeing. And to the extent that that continues, much like in 2008, you can expect gold and silver to fall further. My primary scenario is not a 2008 scenario. I've cited this risk in my articles for Spot Money, but my primary scenario is what's been happening has been a drop, and we could see a further drop. And going back to the issue of technical analysis, the levels that I'm watching, and I've cited repeatedly, with regard to gold and silver are around the 1420s, the low 1420s in gold, and 1650 in silver. And that's a technical level, it's a Fibonacci level in both. And I will complement that with what I'm expecting for the 10-year. And I said this one is at 151. 2 to 2.3%. 2 is my primary target, worst case 2.3%. TIP, which is the inverse of real yields, Treasury inflated protection securities. The TIP price, I'm looking for a drop back to 114 to 112. 114 being the primary, 112 worst case. And then TLT, you can look at 134, worst case 126. So those are the levels that I'm watching, because in the short term, I think gold, well, obviously gold and silver are under pressure, and it could be continued pressure on both metals in the short term. But this is a buying opportunity, in my opinion. Unless we see all those levels broken, I expect this to be a buying opportunity. I think this is a wave 2, to quote Elliott Wave parlance, and wave 3 of 3 is next. And when that happens, we're going to new highs.
Yeah, it's interesting you mentioned that, because I think that's where a lot of people wonder how, myself included, how to reconcile the fundamentals with the technicals, where you have certain levels, and then back to what we started the call with, where you're talking about how the Fed's printing money, whatever they want to call it. So how do you reconcile those two? And you can take it whether from the short, medium, or long-term perspective, but what's a good way for people to think about approaching that?
Well, the issue on the fundamental side is that the Fed is injecting liquidity into the repo market and into the market at large, but it's all on the short end. And so it's benefiting the short rates, it's potentially benefiting equities as well. But it's not affecting, when I look at real yields, I look at the 10-year primarily. You can look at the 5-year, but rarely look at the very short term. and it's steepening the yield curve. The 10-year yield's rising as a result of the Fed's actions, it's steepening the yield curve. And that is putting, at the same time, that economic data is weak, so you're getting inflation expectations starting to tilt to the downside. And that's forcing real yields higher. And given the correlation between the two, that's why gold and silver are going down. But again, I think this is just the first step, and this is why we get the debate over QE, whether it's QE4 or not, that this is just the first major step that the Fed's taking. You could argue that the cutting rates came before that, but it was always about QE for me. And this is QE light, QE4, not QE, whatever you want to call it. But I do believe they're going to do full-blown QE at some point soon. You know, whether they need a crash in stocks to do it, but the other alternative is that bond yields continue to rise. And they can't have bond yields continuing to rise given the sheer amount of debt that's on the books.
Right.
Because then the U.S. government would look insolvent. The interest expense, the projected interest expense in their budgets would go through the roof. So there could be a level, be it 2.5, 3%, maybe even 2%, that the Fed goes, okay, enough's enough, and they decide to cap yields. They've already talked about it, Brainerd, et cetera, now Powell as well, where they come in and they cap yields. At that point, where they cap bond yields, so this brings the fundamentals back to the technicals, back to where I think gold and silver are going. When they come in and they do full-blown QE and start buying treasury securities out the curve and cap yields in the process, well, you know, stocks are probably going to take off. You'll get inflation expectations start to turn around and go up. And if nothing happens, and I don't expect it will with regard to the economy from renewed QE, much like Europe and Japan have demonstrated, there'll be a call for MMT. And when that happens, that's putting all those printed dollars into circulation, and the velocity of money starts to take off. Gold and silver will soar like you've never imagined. They will just explode higher. The reason why QE3 did not, you saw gold and silver dump when QE3 came out, was people realized that QE1 and QE2 didn't create any inflation. Well, if we get MMT on the next go round, which I expect we will, given the current climate, many of the Democratic presidential candidates have already talked about MMT, quite excitedly, I might add. When we get that, you're going to get inflation. When you start dropping money from helicopters on the economy, you're going to get inflation. I would argue stagflation, and that could potentially turn into hyper-stagflation. And when that happens, just gold and silver just goes through the roof. So marrying fundamentals of the TA. In the short term, the Fed's its actions are very specific to the short end of the yield curve. That's why you're seeing pressure on gold and silver, given what's happening on the longer end of the bond curve, if you will. And but when the Fed goes to the next action they're going to take, be it a crash in equities or you wouldn't say a crash in stocks, but higher bond yields to cap bond yields, that's the trigger that gold and silver just see at time.
Yeah, I appreciate you mentioning that because I'm sitting here looking at the Fed's balance sheet, and it's interesting. We had the highs in gold and silver in 2011 when the balance sheet was up above between $2.5 and $3 trillion. I would say that many of the folks who are bearish on gold or silver have been so over the past couple of years. My guess is that most of them would say, well, the Fed's been tightening, although what I'm guessing they wouldn't be aware of is that we're still, I mean, even though it got down to about 3.8 on the balance sheet, still well in excess of when gold and silver were at their highs. So at least to the degree that if we think about pricing gold and silver as, you know, an asset and it's really the money supply that's changing, you know, there's a lot of folks, myself included, who have been waiting for a retesting of those gold and silver highs. I think you kind of just answered it in the last question we covered, but is it really, do you think when an overt QE4 or QE to infinity is launched, that's when we finally see $1,900 gold, or what does it take to get there?
Well, the confusion that I think reigned in the past, going back to, I like to look back at history. I'm often tweeted that those who ignore history are doomed to repeat it. And the point being that if you look back what happened in post 2009 when we got QE1, 2, and 3, everyone expected QE1 and QE2 to create inflation. And it all comes back to real yields at the end of the day, because real yields are highly correlated to goals over time. There are periods where they break down, but they're highly correlated over time. And QE1 and QE2 did little for the economy. It saved this banking system. It created another mini credit bubble, but the did nothing for inflation. We know this looking back at CPI. Well, look, and I have other people out there who say, "Oh, inflation's taking off." Quick aside: inflation in necessities for people, food, gas, tuition, healthcare, has gone through the roof. Inflation of discretionaries is in disinflation or deflation right now because people have tightened their belts and they're at peak debt. So just to put that aside. But QE1, QE2 did not cause inflation to go through the roof. And why is that? Because all the money they printed went straight onto the Fed's balance sheet as excess reserves. It did not get poured into the economy. Yes, some of it filtered through, but it was by no means a waterfall onto the economy. When we talk about MMT, by contrast, just to illustrate the point, we're talking about dropping money from helicopters onto the people. So the difference is money supply, base money, increased, sure, but the money in circulation, which is different, is the money that actually was created and didn't go into a vault somewhere at the Fed, but actually was sent out into the economy, for want of a better term, and was used in multiple transactions. Therefore, the velocity went up. That's inflation. You need a combination of money in circulation and velocity. When those two go up, you get inflation. We didn't have that. That's why when QE3 came around, gold dumped. And now we have QE light and gold and silver falling again. That doesn't make sense. Well, watch what happens when to answer your question, Chris, when they go to full-blown QE, and then you've got a 2020 presidential election coming down the pipe, and the Democratic candidates are talking about it, and you've got AOC talking about it. No comment. But when this is a very, very real possibility, regardless of what Pell says, because the people will demand it. It's not solely about QE for the rich, QE for the people. Well, when that happens, then that helicopter drop occurs. The money goes into circulation, and people start feeling good again. We got universal income or basic income, where we got the government spending freely. It's fine. The Fed's going to finance it directly. That's money going straight into the economy. Velocity is going to pick up. Supplies and circulation is going to pick up. And then you're going to get inflation. That's when gold and silver take off. And by the way, at this same time that inflation is taking off, what's happening with yields? They've been capped at 2%. So what happens to real yields? They're down in the basement somewhere digging a hole to Australia. That's where real yields are. And that's why gold and silver will explode. And by the way, I want to get this in. Gold will take off, yes, but silver is just going to skyrocket. Look at the gold-silver ratio. We almost tagged 100 there recently. That's going back down to 30. So if gold goes up 3 to 5 times, that means silver is going up 9 to 15 times. Just keep that in mind.
Well, David, I can assure you there are a few things that I think about less than that. In a nutshell, that's the big part of the reason why I left Wall Street, and perhaps to share what I've seen. So I know people were upset when they get clobbered by some of these crises without anybody warning. Yes, I do see at some point some numbers for both gold, but particularly silver, that probably would stun most people. And we'll continue to see when that happens. Perhaps the last question for you today. We do have a Fed meeting coming up at the end of October. I guess that's in 2 weeks now. Any expectations of what they may or may not do then, or when we actually do see QE4?
No, I think they've shot their bolt for now. The only issue is whether or not they're going to cut at the next meeting, and I don't know, but I would expect. I'm leaning towards a cut, but now that they're injecting money into the short term of the yield curve, they may not need to. They may want to save that ammunition for down the line. We'll see. But I think there's not much that they can do in the short term to follow up on what they just announced. And as I said, I don't expect full-blown QE unless, what if stocks decide not to go up here? Well, if they, they try, and we actually head south again and hit new lows of 2,200, that's a guarantee you're going to get full-blown QE. The other alternative is if stocks continue going up, that they pull money out of the bond market and the 10-year yield goes north of 2% to 225 to 250, 275, 3. At some point, they're going to say, no, I don't think so. And I know some people, including Luke Groman, have always thought that it would be the bond market that triggers full-blown QE, not stocks. And in that scenario, the latter scenario, where bond yields take off, they will want to come out and cap it. They've said so themselves. And the obvious reason, I said so earlier, is that they can't have bond yields go to 2.5% to 3%, or certainly north of 3%, because the interest expense on the existing debt that is already soaring, and next year is going to balloon even higher when unfunded liabilities start coming due. The government would be clearly insolvent. China and Russia have already figured this out. They figured this out 10 years ago. That's why they've been hoarding gold and silver and dumping US assets. The Fed is going to have to monetize all that debt in order to keep bond yields at 2% or lower, much like the Japanese have done. That bond market is essentially dead. It's most of the bonds are owned by the Bank of Japan. The difference for the US is we hold the global reserve currency. We have twin deficits. The Japanese don't have those issues. So if the US were ever to get into a situation where there was a perception of insolvency, then there's a lot of reserves abroad that can come back to the US when they start dumping dollars. A lot of people cite the reserves as a positive. I consider it a negative. It means there's a huge pool of dollars that could waterfall back into the US. Well, what about all the dollar-denominated debt? What, they can't default on it like Argentina, and then Argentina gets SDRs from the IMF, and guess what they do? They swap it out for dollars. Where do they get the dollars from? China. We could see the same thing happen tenfold when this comes down the pipe. So the issue at the end of the day is, I think the debt is the number one problem, and that's not going away anytime soon. It's just going to get worse. And in order to avoid the perception of insolvency in the short term, the Fed is going to have to revert to full-blown QE. And I say it could be a crash in stocks, which reduces federal tax receipts, which has the same effect. It makes the government look insolvent because you less revenues in ballooning welfare payments, or the interest expense on the bond yields goes up because on the bonds goes up because bond yields go up. Flows go out of one into the other, and that whichever one plays out, you get the same result, different route, same destination. The Fed will have to resort to printing, and when that causes assets to go up, but the economy doesn't recover, then you're going to get the screams from the voters going into a 2020 election saying, "Hey, what about us?" And then that's when MMT comes. And then I start looking for villas in Montenegro and Bermuda and so forth, because gold and silver are going to explode at that point.
Yeah, I appreciate you mentioned that, because especially I found it interesting in the recent CBO, Congressional Budget Office report. One of the things they mentioned in their forecast was that the budget levels or the deficits that they forecast, these were all assumptions based on lower interest rates over the next decade. So like you point out, there's a lot of people that are counting on that, and which means probably a lot of people are counting on the Fed to do exactly what you've just outlined. So with that said, as we wrap up, maybe you could just let folks know where to find you on Twitter and follow your commentary going forward, because I think you're spot on and they'd be well served to know what you're saying.
Yeah, Chris, can I just finish with one other point, and I'll do that.
Sure.
A lot of people use the term the Fed's put itself in a corner. As I've just described, they have. Whether it's stocks or bonds, they usually move inversely to one another. So whether you get a crash in stocks or you get a spike in yields, the Fed is forced to revert to QE. But it obviously does nothing for the economy, which is demonstrated aptly by Europe and Japan. which are now Europe, after a month of switching off QE, went back to it. And the BOJ is ramping up their QE again, even though they're on QE 24 and it still hasn't worked. So the point being that they're going to do that again. It's not going to do anything for the economy, and it's a very populist environment these days going into a 2020 election for the president and the other for Congress too. And they're going to demand MMT. I don't see any alternative other than they say throw up their hands and let everything collapse. Let the credit bubble, the everything bubble burst. I've never known politicians to agree to such an outcome throughout history. So for me, this is all inevitable. It's just a question of timing. And if you're a gold and silver investor and you buy the physical metal and you stick it in a drawer and forget about it and let it collect dust, nobody can guarantee anything, but I feel highly confident that your listeners are going to benefit tremendously because there is no alternative. Um, and in the event of a collapse, when that does occur, yes, gold and silver will fall in a deflationary environment, but here's the deal. Everything else will fall even more so. Real estate, stocks, prices of goods and services. So don't just measure gold and silver in terms of currency, which is the dollar is going to run into trouble in my opinion, but measure it in terms of real goods and services. Gold and silver is the only safe harbor for what's coming. And in the meantime, just wait for the Fed to do the only thing they can, which is print money and print money ad nauseum, blow out their balance sheet. As Jim Records says, I agree with him on most things. I disagree with him on some things, but he's dead spot on this one. There is a threshold of confidence with regard to the Fed's balance sheet. Is it 10 trillion, 15 trillion, 20 trillion? And these numbers may sound ridiculous, but you have to keep in mind that the Fed exploded its balance sheet by 4 to 6 times last time around.
Yeah.
But if they're going to get the same result, given the diminishing marginal returns in debt, they're going to have to do 4 to 6 times again. Well, 4.5, if I do grade school math, 4.5 times 4 is 18. 4.5 times 6 is what, 27? 27, yes.
Yep.
That's 27 trillion, 18 to 27 trillion. At what point does the world go, this piece of paper is worthless? And that's the point where gold and silver come into their own. And you've already seen the likes of Carney and IMF officials, some IMF officials, others are saying no, but talking about gold being this coming back to the center of the system and a new global reserve currency having to replace the dollar. When that happens, when there's a global monetary reset, we'll have a shoot higher in gold, then a pause, and then a reset, and it goes even higher because the way to get rid of all this debt is to inflate it away. And you can inflate it away with hyperinflation, or you can do a global reset where you revalue all currencies against gold at some higher value, 10,000, 25,000 gold, and there's your inflation. And the debt is reduced dramatically. Of course, savers are wiped out. But that's why I just wanted to say for your listeners, we can talk about short-term trading, we can talk about technical levels, but long-term, I don't see any other alternative than gold and silver going higher. And that's just my opinion. So to answer your question, where can you find me on Twitter? At Global Pro Trader. That's where you can find me on Twitter. And you can also find me on Sprott Money. Just look under the Insights blog, David Brady, and you'll see my articles there. I post them weekly, typically on a Thursday.
Well, David, I appreciate that and certainly would recommend folks to go on there and follow you because you share some great insight. And I love that last point you mentioned because that's similar to how I felt for the last decade once I started getting into this, where, yeah, the short term, and I say this as a former equity options trader, so it's very short term in nature. Tricky thing to do in the gold and silver markets, but like you point out, if you leave the metal there, unless someone can explain how these governments and banks are ever going to repay the debt or unwind this stuff, which I don't see being possible. Like you said, I think in the long term, again, this is not legal financial advice, but just two people who have studied these markets, I think we're full agreement on these. So Again, I really appreciate you joining me. I'll look forward to checking in with you again soon. Who knows what'll happen between now and then, but actually, I think you laid out pretty clear what folks might be able to expect. So thanks again for all you do, David, and we'll look forward to checking in again soon.
Yeah, Chris, one last thing. Debt, you bring it down to a personal level. You can pay it off. US can't pay its debt. You can default on it. We're not going to humiliate ourselves by defaulting on it outright. Or you can inflate it away. It's obvious what they're going to do. Buy gold and silver. Thanks very much, Chris. I really appreciate it.